Hello, this is a group presentation on earnings management in Tyco Company. The group is Brian Landry, Max Grafton, Grant Williams, and myself, Travis Markey. Earnings management is the idea that a company will create financial statements that makes the company look like it is in a better position than it actually is. This is very similar to fraud because it paints an overly positive picture of a company's business activities. This takes advantage of accounting rules such as when businesses incur expenses or as to when they recognize revenues. There are quite a few reasons for a company to use earnings management. One very good reason would be to attract investors. Investors will be attracted to companies using earnings management because if they were going out of business and a company is overstating their income, then obviously they look like they were doing very well. This is caused by greed and opportunity.
Travis, I'm Brian Landry. All right, so as Travis was mentioning before, you're talking about earnings management. There are different types of earnings management. There's cookie jar reserves, capitalization practices, big bath one-time purchases, operating activities, merger and acquisition activities, revenue recognition, immaterial misapplications of accounting principles, and reserve one-time charges. And all of these are pretty much when a company but shows different revenues being earned in different periods, or not putting something on the books that should be on the books, and stuff like that. So the two types of earnings management that we'll be talking mainly about today are cookie jar reserves and big bath accounting. And cookie jar reserves is pretty much when a company states more liabilities than they have to generate revenue when they need it. So they kind of stash revenue in a certain area and then they can pull when they need it, which is kind of why it relates to the cookie jar. Like you put cookies in there and then you can pull whenever you want or need one. And then big bath accounting is when you make a large purchase that affects the company or affects someone in the company but doesn't go up against the stock price, because that money's taken out of the company, then the stock price will lower, but this doesn't go anywhere on the books of the stock price, so it still looks like the company's doing well even though they're trying to hide money somewhere. All right, as you can see here, we have now a list of companies that have been caught using earnings management, and pretty much what all these companies have in common is that they misrecognize revenues, or they purposely put revenues into a different month or period to try and make themselves look like they were doing better in one period even though they weren't, and they would take away from a period where they think they'd be doing well regardless of whether or not they had those assets in their period. So I'm not going to go through each example specifically, but we will talk about Tyco later on in the presentation.
Thanks, Brian. My name's Grant Williams, and as Brian was mentioning earlier, I'll be talking about Tyco. Tyco International is a Swiss security systems company which originated in Switzerland and now has a U.S. office in Princeton, New Jersey. The main point of Tyco is they install security systems and they monitor intrusion, fire, flooding, and smoke detection. So what actually happened with Tyco International is that Mr. Schwartz and Mr. Kozlowski, the CFO and chief executive, colluded together to perfect their plan. Mr. Kozlowski secretly authorized the forgiveness of tens of millions of dollars to loyal executives. He wanted them to stay loyal, so by authorizing their forgiveness, they stayed loyal. Also, Mr. Kozlowski specifically spent tens of millions of dollars in personal spendings, all the way from his own checking account. The main reasons that led to the fraud, or the earnings management, is the financial pressures and rationalization. So what happened within Tyco International is that they had to cut spending on employee salaries. So people felt pressure because they were cut back from their money, and obviously they wanted more. Both Mr. Kozlowski and Mr. Schwartz had created a culture of greed within the company. So people within the company just wanted more money. And the rationalization was that they thought it was okay because they were making that same amount of money before, but because of the cutbacks, they weren't making that much anymore.
Thanks, Grant. I'm Travis again. Okay, so workers' compensation. Basically, this was just a huge scheme. Kozlowski designed the new compensation for his employees, but it was a big trick. He promised them extra bonuses, bigger workman's comp. However, what he did instead was never actually gave them the bonuses. He kept the extra money if he put it in his pocket and kept it for himself. Yet, he got away with it because it didn't affect the stock price, because it didn't affect the income statement, because the bonuses were already supposed to be paid to the employees. Therefore, it looked like the money was already gone.
Thanks, Travis. I'm Max. I'll be telling you about the consequences. So, They were finally arrested in 2002 for all these crimes, and they were prosecuted in 2003 with a prison sentence of 25 years, and they were not eligible for parole until 8 years were served. And they were also feed and fined with hundreds of millions of dollars for these. So I'm going to talk about how ethics played in this. Ethics are their moral values, and they diminish their own moral values by committing these crimes. These unethical crimes spread throughout the whole corporation and encourage their workers to push the limit. So there are ways to prevent events like this from occurring in the future with internal controls, such as establishment of responsibility, segregation of duties, documentation, procedures, and independent internal verification.